Welcome back to Talk Tickers. If you are listening, you know the drill. We're the briefing you need to bypass the fluff, strip out the PR spin, and get straight to the numbers that actually move markets.
Exactly. We're here for the alpha, not the mission statement.
Today, we're training our lens on a ticker that's making a very interesting splash, or maybe, given the market reaction, a ripple that should have been a splash.
That's a good way to put it.
We're breaking down the Q4 earnings for Central Bancompany, ticker CBC. And I have to say, this is a bit of a weird one.
It's a fascinating anomaly. You've got a bank that's been around for 50 years, a half century of history, but this was their inaugural earnings call.
An inaugural call since their IPO, right,
Yeah.
late 2025.
Exactly. So it's this strange new kid on the block moment for what is essentially a grandfather of the industry.
A 50-year-old startup in the public markets. You don't see that every day. Now, before we even get into the balance sheet, I want to talk about the call itself. I listen to dozens of these a quarter. They're usually an hour-long slog through corporate speak and safe harbor statements, but this one,
It was efficient.
ruthlessly efficient. The whole thing, prepared remarks, Q&A, everything was wrapped up in just over 20 minutes. I mean, I barely finished my coffee.
Yeah.
So is that a red flag or is that a flex?
In this context, it is a massive flex. Think about it.
Yeah.
When the numbers are bad, you talk for an hour trying to explain them away,
Yeah.
right? You talk about headwinds and macro environment.
Or you try to spin it.
But when the numbers are good, you drop the mic and you walk away. And the numbers here were, well, they were objectively solid.
Okay, so let's get right to the scoreboard. The headlines looked pretty clean.
Oh, absolutely clean. No footnotes, no weird one-time adjustments.
So GAAP EPS, what was the final number?
Came in at 47 cents. That beat the consensus estimate of 46 cents.
Okay, so a beat and on the revenue line.
272.3 million. That was a solid beat over the 265-ish number the street was looking for.
So a beat on top and bottom. Net income was, what, over 100 mil?
107.6 million for the quarter. I mean, by any standard metric you want to use, that's a beat.
And yet, and this is the disconnect we have to unpack, because this is where the opportunity might be. Despite the beat, the market reaction was muted.
Muted is being polite. I'd call it lethargic.
The stock closed down about 41 cents, right? So that's what, 1.7%, landed around 24.40.
Yep. You beat top and bottom, you post record profits, and the market just says, meh, sell it. It's frustrating. So what gives?
Well, this is where you have to look closer at the tape, because it wasn't a high volume sell-off
Not at all. The volume was incredibly light. We're talking about, what, 7,300 shares traded?
versus an average of over 200,000. So this wasn't institutions fleeing the ship.
No, it wasn't fear. It was apathy. It was a lack of liquidity and, frankly, a lack of fireworks. The market wanted a huge announcement, a deal, a buyback, something sexy.
And they didn't get it. So the fast money just drifted away.
Exactly. But boredom is often where you find value. So let's dig into those fundamentals. Management kept repeating the phrase, record profitability.
Is that just talk, or do the numbers back it up?
Oh, the math absolutely backs it up.
Yeah.
The metric that really jumped out at me was the net interest margin, the NI.
Okay.
On a fully taxable equivalent basis, they're sitting at 4.41%.
4.41, wow. For anyone who doesn't follow banks that closely, let's just say most regionals would kill for a neg that starts with a 3 right now.
Exactly. And their return on average assets, the ROAA, is 2.17%. These are heavy hitter numbers.
But here's the crazy part, right? The context. We're in a rate cut environment. The Fed's cut 75 basis points.
Right. And the textbook says when the Fed cuts, a bank's loan yields are supposed to drop right along with them. It's gravity.
Margin compression. That's what you expect.
Well, CBC's loan yields dropped by 1 single basis point.
1 basis point. That's a rounding error. It's basically 0.
It's statistically 0.
Hang on, break that down for me. How is that even possible? How do you defy gravity when the Fed is slashing rates?
It shows incredible discipline in how they structured their loan book. They've positioned themselves to be, and I'm quoting them, neutral to the front end of the yield curve.
Which means their assets aren't repricing down immediately as the Fed cuts.
Precisely.
Yeah.
So while other banks are getting their margins squeezed, CBC is just holding the line that at 441 INM is a fortress.
Okay, so the spread is strong. What about the quality of the assets? Because high yields can sometimes just mean high risk, right? Are they just chasing junk?
That's always the first question you have to ask. But management called the portfolio pristine, and the data supports it. Net charge-offs were just 10 basis points.
10 basis points. That's nothing. That is a squeaky clean portfolio.
It is. So they aren't stretching for yield, but we do need to look at the other side of the balance sheet, the deposits. Because I think some of that stock drift was from people misreading the deposit growth.
Right. I saw deposits were up 1.7% and 6% year over year. Looks great on the surface.
It does. But this is a bit of inside baseball for how Missouri banks work. A big chunk of their deposits, about 17%, are public funds.
Money from cities, counties, that kind of thing.
Right. And in Missouri, property taxes all get collected in December.
Yeah.
So every Q4, you get this massive tidal wave of cash hitting the bank's balance sheet.
Oh, okay. So the balance sheet looks swollen with cash, but it's just tax money passing through.
You got it. And management was very upfront about this. That money is going to bleed off in Q2 and Q3 as it gets spent. So if you're an analyst, you cannot model that Q4 bump as permanent.
That's a crucial detail. You'd get your Q2 numbers totally wrong.
Exactly. But speaking of capital, we have to get to the elephant in the room.
No.
The war chest.
This was the part of the call where I actually stopped and just stared at my screen. They have $1.8 billion in excess capital.
It's a staggering number for a bank their size.
Let's put that in perspective for you. The stock is trading at around $24. They have about $7.50 per share of dry powder just sitting there.
It's nearly a third of the market cap in cash.
And this is the core conflict of the whole story, right? This is the friction. You have this massive pile of cash. You have a CEO, John Ross, reminding everyone they've done 47 acquisitions in 50 years.
M&A is their entire DNA. It's not a hobby. It's what they do.
But they didn't announce a deal.
They did not.
And this is where I put on my angry shareholder hat. I'm looking at $1.8 billion earning, treasury rates? When they could be buying back stock or buying a competitor and getting a real return on it.
And they teased it too. They said they have a target list of 30 names and are in active talks with half of them, 15 banks.
Looking at Dell's around $2 billion in assets, and they even mentioned Texas as a target for expansion, the blueprint's there.
So why the delay?
That's the question. Why are they holding the ball and refusing to shoot?
Their answer was one word: patience. And the market, as we know, hates patience. The friction is investors seeing that cash earning maybe 4% when it could be deployed into a deal generating 15. It's the opportunity cost.
So why not just announce a big buyback? At least do something.
Because they believe the right deals are coming. John Ross said they want the right deal, not a timely deal. And they were very clear. No breadcrumbs, no updates until a deal is signed.
Which is responsible, I guess, but it makes for a boring stock.
It does. But think about the strategy. Small banks are under immense pressure right now. CBC is the shark swimming around waiting. They have the stock as currency. They have the cash. They hold all the cards.
So they're waiting for other banks to break so they can get a better price.
They're waiting for the perfect fit. Patience now could pay off way more than rushing into a bad deal just to appease the market today.
Fair point. Okay, so away from M&A for a second. Is the core bank growing?
It is. Loan growth was up 1% quarter over quarter, which sounds low. But remember, they're intentionally shrinking their installment loan portfolio.
Right, cutting the dead weight.
Strip that out, and the core loan growth is actually mid-single digits. That's a healthy pulse in this environment.
And I saw that shout out to their wealth management business. Assets under advice grew to $16 billion.
That's a hidden gem. That's sticky, fee-based income that isn't tied to interest rates. If they can scale that, it warrants a higher multiple on the stock.
And they are expanding physically. 2 new branches in St. Louis, 1 in Denver.
Which brings us to their rate outlook. This is key. They are modeling a steepener curve.
Okay, let's break that down for everyone. We hear it all the time, but what does a steepener actually mean for CBC's bottom line?
In simple terms, banks borrow short and lend long. A steepener is when long-term rates rise relative to short-term rates. The spread gets wider.
And a wider spread means more profit.
Bingo. They're modeling 2 Fed cuts in the second half of 26, which lowers their short-term borrowing costs. But because they have fixed-rate loans, if the long end stays high, they keep their high yields.
It's the Goldilocks scenario for them. Costs go down, revenue stays high.
Exactly. They claim to be much less sensitive to Fed cuts than their peers, which is a defensive quality the market is just ignoring right now.
So let's zoom out. If you're an investor looking at the regional bank ETF, KRE, why would you pick CBC out of that basket?
It's the narrative. KRE has had a nice run, but CBC is a pure consolidation play. You aren't buying it for the 1% loan growth. You're buying it because they're the ones holding the gun with $1.8 billion in it.
You're betting on management executing deal number 48.
That's the thesis. The bear case is they sit on that cash for 2 years, do nothing, and the ROE suffers. The lazy capital scenario.
Right, and the bull case?
The bull case is they announce a great deal in Texas next month, and the stock pops 20% overnight because that cash is finally put to work.
It's a waiting game, but a waiting game with a pretty high floor.
A very high floor. That $7.50 per share in cash is a tremendous safety net. It limits your downside in a big way.
Okay, that is the perfect segue. We've done the fundamentals, the patience, the math. Now, let's get irresponsible.
My favorite part of the show.
This is not financial advice. We pitch a trade that's outrageous, speculative, but plausible. Expert, what do you have?
All right, I call this one the prairie dog hunter strategy.
The prairie dog hunter. I'm intrigued. Go on.
The logic is simple. The market is asleep. The volume is light. They're bored. But we know the CEO is talking to 15 targets right now. A deal is a matter of when, not if.
Okay, so a catalyst is coming.
Right. So the trade is you go long CBC equity. Simple enough. But to juice the returns while you wait, you sell out of the money puts.
Selling puts. Okay, so you're betting the stock won't crash.
I'm betting it has a concrete floor made of cash. With $7.50 a share in the bank, it's incredibly hard for the stock to fall below a certain level. So you sell puts, you collect that premium, and you get paid to be patient.
I like it. You're creating your own dividend while you wait for the M&A pop. The cash pile is your insurance.
Precisely. But if you want to get really wild with it, you add a second leg to the trade.
Get me.
You stay long CBC, and you short a basket of small, private, Texas-based banks, using public proxies, of course, that are not on the target list.
Whoa, that is nasty.
It's a predator-prey trade. When CBC finally rolls into Texas with its war chest and superior tech, what happens to the small local guys? They get crushed.
Long the hunter, short the prey. That is ruthless. I love it.
It is.
And just to be crystal clear for everyone listening, do not actually do this. We are a podcast, not your financial advisor. Selling puts can absolutely blow up your account.
Absolutely. This is for entertainment and thought experiment purposes only. Do your own homework.
All right, let's wrap this up. We have a clean beat, a massive pile of cash, and a market that basically shrugged because it wants action now, not patience later.
It all comes down to that capital.
Yeah.
It's rare to see a bank with this much flexibility. They get to choose their future, while most of their peers are just trying to survive the present.
That's the takeaway. They have the gun loaded with $1.8 billion. The only question is, when do they pull the trigger?
And when they do, you'll want to be watching that ticker.
That does it for this deep dive. Thanks for listening to Talk Tickers. We will see you at the next bell.